Hey everyone, this is Kirk here again at Option Alpha. So in this video, I want to go through what an opening range breakout or ORB strategy is for 0DT options traders. So look, the reality is that I've never traded a traditional ORB strategy. It was just too much of day trading for what I'm used to as a typical options trader, I guess you could say. But now that we have automations and backtesting inside of Option Alpha, ORB strategy is very attractive and could complement the existing 0DT strategies that I'm already running. So I'm on this journey. I'm going to document it as we go through this here together. This is, again, kind of a mini part series here that we might get into, or behind the scenes, whatever you want to call it. But this first one here is just trying to understand what the ORB strategy is and how we can start to backtest ORB strategies inside of Option Alpha. So first things first, what does ORB mean? And again, I understand what ORB is. I've known about this. I know people trade it. It was just never something I really did because I didn't do a lot of day trading. So it was never something I classically did. But now I can do it with bots. So I'm a lot more interested in it. Again, there's lots of people who already traded at Option Alpha. I'm on my own personal journey to find what works for me. So you find what works for you and we all share along the way. So here's what an ORB basically means. So ORB again stands for opening range breakout. It basically, as a lot of things in options trading, basically tells you exactly what the strategy is that you have this range that you're going to determine and let the market kind of open and move in. And for a certain period of time, and that timeline can be different. It can be 15 minutes, 30 minutes, 60 minutes, etc. You're basically going to sit on your hands and watch. Now, this is the main reason. This is the number one reason why I never traded this strategy when I could do it manually, or if I could have done it manually, is because I frankly don't have the time or the patience or the skill to just watch the market for 15 minutes and then determine those ranges and then try to quickly execute a trade or wait for the rest of the day to execute a trade. So if you're doing that manually, you're probably in the same boat as me and you wanted to do it something a little bit more automated. But the opening range is basically this time period that you determine. And again, it's completely up to you how you want to determine this time range. But let's just say in this example here, it's 15 minutes. We're just basically going to track the market from the market open to the next or the first 15 minutes of trading. So this would be 9:30 in the morning Eastern time to about 9:45. So all you're going to do in this time range is you're going to just watch the market, and then whatever the high and low of the market is during that time frame, that is going to be considered your opening range. That's going to be the range at which then you judge whether later on in the day or later on in the morning, depending on how you look at it, the market breaks out of that range. And so here you can see in this chart, what we did in this graph here is we have our opening range, and then we basically judge our high or notate our high and our low here in these dotted red and green lines. So as you move forward here again, this is going to be kind of the lines in the sand, if you will, to determine whether the market is going to break out or not. Now, the goal of this entire strategy is first to determine the range and set the high and the low. And again, if you're doing this manually, it's probably a pain in the butt to do. So using automation makes this a lot easier. You determine that range and then you're going to wait for a breakout. So what does a breakout mean? When does it happen? Well, it could happen at any point, but classically, and this is kind of the classic example here that I'm going through. Classically, once you determine your range, you're going to wait for the market to break out of that range. Now, that could happen right away. I mean, it could happen 5 minutes later, a minute later. It could happen later in the morning. It could happen later in the afternoon, all the way over here. And the market could trade mostly in this range and then break out later in the day. But essentially, the breakout portion of it is you're waiting for the market to create a breakout above its opening range. And in this example here, you can see, even though we're using the 15-minute range for monitoring that opening range, or that 15-minute range for monitoring it, it wasn't until about 10, 20 or so that it actually broke out and kind of busted through that range. Now, there's a lot of talk around this too, where it's like, well, is it the close? Is it not the close? Is it the first breakout? Is it not the first breakout? Do you wait for confirmation, etc.? Lots of different ways to do. Of course, you can test a bunch of different ways inside of Option Alpha. Now, the goal with the breakout is once the breakout happens, or the expectation or assumption is that there's going to be continued momentum in that direction. Again, I've seen a lot of different versions of this. People say it's not always the case, it's half the case or sometimes the case. I would say most of the people who trade an opening range breakout, the assumption is that once the breakout occurs, that you're generally going to get that same continued momentum throughout the rest of the day. And so that's how people would classically trade it. Now, again, you can trade and backtest it that way. You can backtest it the opposite way, where you test strategies where the breakout happens above and you trade strategies below. You can do it any kind of way that you want. But for me, I think this is probably the most traditional way that people do it. That's probably going to be the way that I focus on doing it as well. So again, you have your 15-minute opening range, you got your breakout, and then at the end, the assumption is that the market continues to move in that direction. We don't know how far it's going to move. We just assume that it's going to continue to have that momentum. Now, just so you know, there's also different ranges. And again, that will really determine when these breakouts happen and where these breakouts occur. So as an example here, if we extended out our monitoring range from 9:30 in the morning to 10 o'clock in the morning, you get a wider range to kind of catch and see where the market goes. But that doesn't always mean that you're going to get different high and low values. They could be exactly the same as the first 15 minutes. It could be completely different, but you're just giving the market more time to kind of set that range. And again, there's pros and cons of doing this. A lot of people would say you do the early morning. A lot of people would say give it more time. We'll definitely test everything as we go through this series. Now, again, if you do a 60-minute range and you give it a lot more time, obviously that's going to change how you set these highs and lows. So this is an example that we're using the same low that we had in the 15-minute and the 30-minute range, but because we set our opening range to 60 minutes, so the first hour of trading from 10:30 or 9:30 to 10:30, you can see that our high was actually set much higher. So now the threshold for a breakout is set much higher and doesn't really occur until later on in the afternoon, maybe somewhere around 11 o'clock. Again, the same underlying assumptions stay the same, which is that once the breakout occurs, we generally assume that the market's going to continue in that direction. Now, of course, it doesn't always have to break out higher. It can always break out lower. So you have high breakouts, you have low breakouts. Here would be an example of a low breakout using a 60-minute range. You've got your high that's set, you've got your low that's set, and then eventually you get the break lower. And again, the assumption is it continues to move down or sideways, or it just doesn't go back above the high end of the range throughout the rest of the day. So these are the ways, broadly speaking, that the opening range breakout strategy works. Now, the most important part here is, all of this being said, how do we test this? And that's where it comes into backtesting. This is where you're going to spend time as a trader, and you should be doing this as a trader, spending your time doing the backtesting and research. So we'll start that process today, and then in a future video, we'll do more backtesting and research and try to refine it as I try to find my own strategy. I'm not trading anything right now. I'm on an exploration process and path to try to find a strategy. But let's just run a backtest right now using the opening range breakout and just trying to do something around an opening range. So I'll go into the 0DT backtester. I'm going to click SPX. I'm going to go to 0DTE. I'll leave the strategy as a short put spread for now. When it comes to the short and long puts, I'm going to do something first where I go to the short put option, and I'm going to go down here to this recipe. You can see this recipe is one that includes the opening range kind of variables, if you will. So now what I can do is I can select this recipe to kind of set my short strike first. I'm going to do $1 below. So in this case, because it's a short put spread, I want to test that breakout higher where the market goes higher. I'm going to test a short put spread just below the breakout. So if I were to go back to the chart here, for example, and this was our range, if we had a breakout right here, I'd ideally be looking at opening a short put spread right below here. So that would be the goal of this first test assumption is, hey, if we're going to move higher and we're going to assume that the market moves higher after this and kind of fades higher, momentum continues. Okay, great. Let's do the assumption where I open a short put spread just below where the breakout occurs. And again, we can test lots and lots of variations of this as we go, but I'm going to say $1 below, and we'll just do, in this case, the 15-minute opening range. We'll do it right below the opening range high. Notice you can do it below the opening range low if you want to. If you did it below the opening range low, then what you'd be doing is you'd be essentially opening your short put spread down here. So again, we can test lots of variations of this. I encourage you to do this as well. Find what works for you, but we'll just test it for this one, the high, and we'll just do or closest. So the closest strike to $1 below the market, and we'll go or lower. So we don't want to go any higher than that. We don't want to open a strike that's kind of in the money already. So we'll do $1 below the 15-minute opening range high or lower, which means that the high end of the range, but the lower strike that's closest. And then what we can do with our long put is we can kind of cue this off of our existing short put, and we'll do $5 below our short put, and we'll go exactly that way. We always have a $5 wide spread for SPX. Personally, I like doing $5 wide spreads for most of my trading because it keeps the risk in line. It doesn't create this huge risk position. Capital, we'll just do the basics, $10,000, one contract at a time. Now, position entry, this is where we can get, have some fun with the opening range breakout. Notice that once I click on opening range breakout, I have my opening range period. This again is going to be your different periods here. You can have your 15-minute, you got your 30-minute, you got your 60-minute, etc. There's a lot of different ones that we have in here. So you got 5, 10, 15, 30, 60. Those are the most classic ones. I'll leave it at 15 minutes for this example again, because I'm also queuing this off of the 15-minute opening range. And then the direction of the breakout, I'm going to go above the high. You can also test below the low. Again, all sorts of different things. Latest entry. So this one's a fun one. Latest entry basically says, look, after you set this 15-minute range, how long are you going to watch until you could potentially enter a trade? Now, some people would say you wait the whole day. Like you go the whole distance basically till the end of the day. So if the breakout occurs in the last 10 minutes of the day, you would trade that breakout. I don't know if I necessarily want to do that, so I'm not going to test it here. I would do something maybe more around like noonish. Like once the breakout occurs, does the market start to move? You get into a position too late in the day, and there might not be enough premium, or a lot of things happen at the end of the day anyway, so it might be a little tough. The other thing that you can do with the opening range is you can set the range width. So this is fun because typically what will happen is that some people will come in and say, well, if the range is crazy, crazy high, then I don't want to trade it. And I agree with that, right? So I'll just set my opening range max to 1%, which means if the open of the market in the first 15 minutes has a 1% range up or down, I probably don't want to trade that day. That means there's a lot of volatility in the day. So I don't know, for this exact test I'm going to do, that's my assumption is I don't necessarily want to trade that where the range is really, really high for the day. At the same time, I probably don't want to trade something that has a really low range. So if there's no movement, I don't want the slightest movement to then be classified as a breakout, and then I get like kind of whipsawed for the day. So again, these are all assumptions. I have no clue what this is going to do. So we're just going to set this to 0.515 to 1%. So I want a little bit of movement, but not too much movement. We'll do all trading days. We're going to do the checkbox to only trade the first breakout. You can, again, test this, but this, again, prevents the bot from trading other breakouts in opposite directions after this one occurs. We're going to skip FOMC. We'll always include slippage. That's just a main staple of this. And then for now, what we're going to do is we're not going to do any profit taking. We're just going to run it to expiration. So just trade the breakout, let the thing go to all the way to expiration. Again, we can do multiple variations of this as we continue moving forward if we want to. And then we'll do 3 years here to try to get as much data as possible. So once we do this, we're going to run the backtest. We'll click here to view the results. The backtest should take about a minute or so to run, and you can see it's already done. And so now we have the details of this very basic 15-minute opening range breakout. I will add a link to this backtest so you can see it right below this video, and you can start to create different versions of it yourself. So here's the backtest for this. It ended up being profitable over the last 3 years. Not anything necessarily to write home about, but it is actually pretty interesting when you take a look at some of the stats. At least to start, things that I look at, obviously total P&L, low, max risk, max drawdown, win rate. You got your profit factor here, which is 1.08, which means a little bit better than dollar for dollar swap, which is great. I look at this and I go, okay, there's probably something here in that the win rate is 64%, which means that I guess you could say the assumption that most traders have that breakout, whenever that breakout higher occurs, you're going to get continued momentum for the rest of the day. Well, this kind of proves the point to a certain degree. If it wasn't the case and every higher breakout reversed, then we'd see a win rate that was significantly lower than this. And again, remember, we're entering the position right below where that breakout occurs. So as close to a line in the sand as you could possibly get on that breakout. So that's pretty interesting. You did have a lot of trades that were filtered out. So there were a lot of entries. I mean, it still has a lot of trades, 314 trades. That's 314 days I don't have to watch it. But you can see the first breakout, that was a lot of filters out, no breakout at all. So some just went for long range and didn't break out. So the opening range was the range of the day. That's probably ones you don't want to trade. Some were below the minimum opening range. So some were a little bit too shy, like they didn't have enough movement. Some were above the max opening range. So there's only 6 of those that were above the max opening range. some FOMC days, some late breakouts, a few early market closes that didn't get in there as well because we want to trade early market closes. So you can see why the different ones were filtered out. This is, again, going to be very helpful as we continue moving forward, because now what we can do from this is we can take this one backtest and we can go up here to the compare button and we can start to add new variations to this. We can start to test new ways of doing the breakout. So let me just add one really quick and then we'll wrap up this video. We'll come back here in the next video and do more testing, probably all testing in that video, testing a lot of variations. But in this case, we're going to take this one here. We're just going to add a variation. So click on the three dots, click add a variation. And then what we'll do is we'll go down here and we'll just actually widen this range out. Now I'm going to keep the 1% range, but we're just going to go a little bit lower on this range. Actually, let's go even lower, like 0.5% or 0.5%. So this should get us a lot more trades, but it'll be interesting to see if those trades actually end up becoming net more profitable because of the more narrow range that we are allowing to be in. So in this case, this one here, test number B, is allowing more narrow entries after a breakout of a narrow range. And you can see actually it wasn't as profitable. So this is actually very interesting. This is what I love. I love doing this stuff where it's like you kind of come in here and you test your hypothesis and your idea. So here you can see we got a reduction in our profit factor. And we also had a bigger max drawdown here. Our win rate was a little bit less, so we didn't win as much. I mean, like, these are all metrics. I mean, you can just look at the chart too and see that, you know, strategy B did not perform as well. So there's a little bit of validity maybe to this that we can use in a subsequent series of backtests where we can start to test some different ranges. But you can see including more strategies in here. And you can see we included a lot more. I mean, so we included like 50 more additional days of trading. But net, it actually didn't help the strategy or improve the performance. So maybe there's something to this idea that the narrow ranges and then waiting for a breakout are not as good as letting the market kind of move a little bit more and then waiting for that breakout. So trade a little bit less, but maybe get better quality signals and entries. So either way, we can test all of this moving forward as we keep going forward. Again, if you enjoyed this video, kind of part one here of my journey through the ORB strategy, let me know in the comments. Give it a like, share, subscribe in the comments below, and we'll see you on the next one.